Most traders spend years perfecting entries and exits while completely ignoring the one variable that destroys more accounts than any bad setup ever could, and that variable is sitting inside your skull right now. The difference between a trader who survives this market long-term and one who blows up 3 accounts in 18 months is not the strategy. It is the internal state they bring to the screen every single session. Nobody talks about how to actually build that state from the ground up because it is harder to sell than an indicator. This video is going to give you the exact framework that separates professionals from people who are permanently stuck in the cycle of learning and losing. There is a specific sequence of psychological events that happens every time an underprepared trader sits down at the charts. First comes overconfidence from a recent win or anxiety from a recent loss, and either one poisons the objectivity you need to read price action clearly. Then comes the trade entry driven by emotion rather than structure, followed by the desperate hope that the market will do what the trader wants instead of what the chart is saying. By the time the stop gets hit, the trader is already thinking about revenge, and the cycle starts over. The traders who stay calm under pressure are not born with a special temperament. They have built a pre-trade process so consistent and deliberate that their nervous system recognizes the routine and settles down before they ever click a button. Think of it like a pilot running a pre-flight checklist, not because they forgot how to fly, but because the act of running the checklist itself creates a state of focused readiness. That mental readiness is not a personality trait. It is a trained response, and you can train it. Your body affects your trading far more than most people in this industry are willing to admit. When cortisol, the primary stress hormone, is elevated in your bloodstream, your brain's prefrontal cortex, which handles planning and impulse control, becomes less active, and your amygdala, which handles fear and threat response, takes over. That is a physiological fact. It means that if you sat in traffic for an hour before opening your trading platform, your brain chemistry is already biased toward reactive decisions, not calculated ones. Before you look at a single chart, you need to run a basic physical reset. 5 to 7 minutes of slow controlled breathing with a longer exhale than inhale activates the parasympathetic nervous system and physically reduces cortisol. This is not a wellness trend. This is applied neuroscience. Studies from the HeartMath Institute have shown measurable improvements in cognitive performance within minutes of using controlled breathing protocols. The traders who dismiss this as soft psychology are the same ones blowing up accounts from impulsive decisions made in a stressed state. Once you have physically reset, the next step is a structured emotional audit. You need to ask yourself 3 specific questions before every session. What is my current emotional state right now? Not what I think it should be, but what it actually is. Am I trading today to follow my system, or am I trading to recover something I lost yesterday? And third, am I genuinely prepared to accept a loss on this trade without changing my behavior as a result? If you cannot answer all 3 honestly, you are not ready to trade yet. The reason most traders skip this kind of self-assessment is that it forces uncomfortable honesty. If you admit that you are angry about yesterday's stopped-out trade and that you are sitting down today to get that money back, then you also have to admit that you should not be trading right now. That admission requires discipline, and discipline is harder than strategy. Anyone can learn a pattern. Very few people can override the emotional impulse to recover a loss by sitting on their hands until conditions are actually right. There is a concept used in elite athletic performance called arousal regulation, and it applies directly to trading. Every person has an optimal performance zone, a level of mental and emotional activation where they perform at their best. Too little activation and you become passive, you miss valid setups, you second-guess clean entries. Too much activation and you overtrade, you enter too early, you move your stop loss. The goal is not to be completely emotionless, it is to operate consistently within your optimal zone. Identifying your optimal zone requires keeping records that go beyond just win rates and R multiples. You need to track how you felt before each session, what your energy level was, whether you were hungry, whether you had slept well, whether you were distracted by something outside the market. Over time, you will see patterns that no indicator can show you. You will notice that your best trading happens under specific internal conditions and your worst trading clusters around specific emotional and physical states. That data is more valuable than any back-tested strategy. One of the most underutilized tools for pre-trade preparation is the written session intention. Before you open the platform, write down in a physical notebook what you are looking for today. Not just the setup, but the conditions under which you will trade it. Write down the specific market structure you need to see, the session window you will focus on, the maximum number of trades you will take, and the exact point at which you will close the platform and call the session complete. This written intention creates a accountability because it forces your future emotional self to answer to your current rational self. The written intention also eliminates one of the most destructive behaviors in trading, which is redefining your rules in real time. When you are in a trade and it starts to look like your target might not get hit, the untrained mind starts inventing new reasons to hold longer. When a setup does not quite meet your criteria, but the candle looks compelling, the untrained mind starts inventing reasons why this one is different. The written intention from before the session acts as a hard boundary that the emotional in-session version of you cannot easily override. Position sizing is directly linked to emotional stability in ways that most traders never make the connection. When you are trading a position that is too large relative to your account, the dollar amount at risk exceeds your psychological threshold for loss. This is not about risk tolerance in the abstract sense. It is about the specific number at which your emotions take over from your logic. If a $200 potential loss causes you to feel physical tension and compulsive urge to manage the trade manually, then $200 is above your threshold, and you need to size down until the amount at risk feels genuinely manageable. The threshold number is different for every trader, and it changes over time. A trader running a $5,000 account might be completely calm with a $50 risk, but starts feeling anxious at $120. That anxiety is not weakness. It is useful data. It tells you exactly where to set your position size so that your prefrontal cortex stays in charge of your decisions. Once you identify that threshold, never trade above it, regardless of how confident you feel about a specific setup, because confidence and correctness are not the same thing. Understanding what market conditions actually require from you emotionally is something most courses never cover. Trending days with strong momentum and clear structure require patience at the entry but confidence once you are in. Range-bound days require more restraint, more willingness to wait, and more acceptance that the market is simply not offering clean opportunities. High-impact news days require the ability to do nothing and feel completely fine about it. Each regime demands a different emotional posture, and if you walk into every session in the same mental state, you will behave incorrectly in most of them. Regime identification is not just a technical exercise, it is an emotional preparation exercise. When you sit down before the session, you look at the higher time frame context, and you ask yourself, what kind of day is this likely to be? If the daily chart is showing a clean trend with no major resistance overhead, and the economic calendar is empty, you prepare yourself for a trending session mentally. That means you mentally rehearse sitting through pullbacks without panicking out of the trade. If the market is compressing ahead of a major news event, you prepare yourself mentally to observe rather than participate. The internal conversation you have with yourself during a trade is the difference between professional execution and emotional trading. Most retail traders narrate their trades in a way that escalates anxiety. They watch a candle moving against them and they think this is going wrong. I knew this was going to happen. I should have waited. I need to get out. Every one of those thoughts is a story, not a fact. The candle moving against you is simply a candle moving. It is price doing what price does in every trade before it either continues or reverses. Developing a neutral internal commentary takes deliberate practice outside of trading hours. You can do this by reviewing recorded trades and narrating exactly what you see on the screen without attaching judgment to it. Price moved to the 50% retracement. Volume declined on that candle. The spread widened briefly. The session high held. This purely descriptive narration trains your brain to process market information as data instead of threat or opportunity. When you bring that same neutral voice into live trading, the emotional reaction to price movement becomes smaller and smaller over time. One of the most powerful but least discussed techniques for staying composed under trade pressure is what psychologists call implementation intentions. An implementation intention is a specific if-then plan you create in advance. If price reaches my stop level, then I immediately accept the outcome and close the platform for 15 minutes. If I feel the urge to move my stop to avoid a loss, then I step back from the screen and revisit my session intention. If I take 3 trades and all 3 are losers, then I stop trading for the day regardless of what the chart looks like. These predetermined responses remove the need for in-the-moment decision-making when your emotions are at their highest. The session close is as important as the session open, and almost every trading psychology framework ignores it. How you end a session determines how you begin the next one. If you close a session by reviewing what happened objectively, noting what you followed and what you deviated from, and then deliberately disengaging from the charts, you walk away with your self-regulation intact. If you close a session by refreshing the chart obsessively to watch the trade you exited early continue in your direction, you create resentment judgment and second guessing that will infect your next session. The psychological phenomenon at work there is called post-decision regret, and it is one of the most corrosive forces in a trader's mental game. Your brain is wired to remember the road not taken more vividly than the road you chose, which is why missed profits feel worse than actual losses of the same size. The antidote is a strict no-review policy after session close. Once you have logged your trades and written your brief session notes, you close the platform and do not look at those markets again until your next scheduled session. This is a non-negotiable boundary if you want to protect your mental capital. Journaling and trading is often reduced to logging entries and exits, but a properly structured trading journal is one of the most effective psychological stabilization tools available. Each entry should include the technical rationale for the trade, but also your emotional state before entry, any doubts or hesitation you felt, how you behaved during the trade relative to your plan, and your honest assessment of whether the outcome changed your behavior. Over 3 to 4 weeks of consistent journaling, you will develop a self-awareness about your trading psychology that no course, no mentor, and no indicator can give you. The data your journal produces is not just retrospective, it is predictive. You will start to notice that certain emotional states reliably predict poor execution regardless of setup quality. Maybe you consistently overtrade on Mondays after a losing Friday. Maybe your best trading always happens midweek when you are physically rested and emotionally neutral. Maybe you perform worse after consuming financial news media in the morning because it biases your directional outlook before you have even looked at the chart. These patterns will change how you structure your entire trading week. Acceptance is the most advanced psychological skill in trading and also the most misunderstood. Acceptance does not mean passivity or indifference. It means understanding with genuine conviction that any single trade outcome is statistically irrelevant to your long-term performance, and that the only thing you can control is the quality of your process. A trader who has internalized this can watch a perfectly executed trade hit its stop loss and genuinely feel okay about it, not because they do not care, but because they understand that a correct process and a losing outcome can coexist without one invalidating the other. Building that level of acceptance requires shifting the metric you use to evaluate your trading. If you measure success by whether a trade made money, you will always be emotionally at the mercy of randomness, because individual trade outcomes contain enormous amounts of noise. If you measure success by whether you followed your process with discipline, you retain agency over your score, regardless of what the market does. Make process the measure. When you execute your plan perfectly and lose, that is a successful trade in the only sense that actually matters for your development. Confidence in trading is not built from winners. It is built from consistency. A trader who hits 7 out of 10 trades but randomly adjusts their plan in real time is building a fragile psychology that will crack under drawdown. A trader who follows their process on every single trade regardless of outcome is building a durable psychology that does not need the market to validate it. The confidence that comes from consistency is qualitatively different from the confidence that comes from a winning streak. One is earned, the other is borrowed, and borrowed confidence always gets called back. The traders who navigate drawdowns without falling apart are not the ones with the strongest strategies. They are the ones who drilled their pre-trade routine so thoroughly that the routine itself has become a source of psychological stability. Even when the account is down, they sit down, they do the breathing, they write the intention, they identify the regime, they set the position size below the emotional threshold, they trade the process. The routine signals to the brain that this is a controlled activity, not a crisis. That signal is what keeps the prefrontal cortex in charge when the amygdala is trying to take over. Markets are one of the only environments in the world where being wrong costs you money in real time and everyone around you can see the result. That creates a unique kind of psychological pressure that has no equivalent in most other professional fields. The way to handle that pressure is not to become numb to it, but to build a framework where your self-worth is genuinely decoupled from your daily profit and loss. Your identity is not your equity curve. Your intelligence is not reflected in whether a trade worked. Your value as a person has absolutely nothing to do with what the market does today. That decoupling is the foundation of everything. A trader who needs the market to validate them will always make decisions from a place of emotional need. An emotional need is incompatible with objective analysis. A trader who has separated their identity from their results can take a clean loss, shrug, and move forward to the next setup without contamination. This is not detachment, it is professionalism. Every elite performance field has this principle at its core, and trading is no different. The ones who last longest in this business are the ones who stop needing the market it to tell them who they are. Every concept in this video works together as a system. The physical reset reduces cortisol so your prefrontal cortex can function. The emotional audit removes hidden agendas from your decision-making. The written intention creates accountability before emotion has a chance to rewrite your rules. The threshold-based position sizing keeps the dollar risk inside the zone where logic stays in charge. The neutral internal commentary keeps your interpretation of price movement clean. The implementation intentions remove real-time decisions from moments of peak emotion. The journal builds self-awareness that no external tool can replicate. Run this system every session, and the calm you are looking for will stop being a goal and start being a default.